From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, January 29th, and you're listening to the Macrocast. Tony Fratto here with Hamilton Place Strategies, Brendan Walsh and John Fagan, as always, with Markets Policy Partners. Guys, earlier this week, I sent out a tweet, just basically, ripping people for, I'll just focus on GameStop, which is like the dumbest thing. And it's inconsequential to the macro economy, the economy at all. It's a tiny stock. It's not that important. Nobody worries about the ups and downs of lots of other stocks. It's a Russell 2000 stock, right? Not even an S&P 500 stock. And, so it's getting all of this outsized attention, which I get because it's, the short squeeze and what the pressure it's put on some brand name hedge funds and, lots of other reasons. But it's just not that consequential for the lives of most Americans. So here we are at the end of the week talking about GameStop, and it's still dominated the news literally every single day this week, and wild swings in the stocks, shutdowns. Look, I get why there's the attention to it. It feeds into this, the weird phenomenon of individualists on a platform like over at Reddit, taking it to the man, whoever the man might be. I just think it's so dumb, and I can't help it.
I'm gonna try to take the sticking it to the man. Well, I'm gonna let someone else take that angle on this whole thing. It's certainly been one of the main aspects of this, and the extent to which you can say, hey, look, margin requirements and trading halts. I mean, these things are not necessarily all that unknown in financial markets. And, having to post margin, welcome to the big leagues, right? And,
right.
The idea that we're shocked that the market might be, structured in favor of some of the biggest players. Okay.
I think, in terms of the biggest players, my view on that, John, is just that, you are big players. If you're a big player, you have regulatory burdens, right? You have lots of regulatory burdens also that guide what you do. And you have the access to resources to deal with your screw ups, and so.
And that's a good point, because yesterday Robinhood had to tap their lines of credit at the big banks because they had breached their liquidity, their capital, regulatory requirements. So that was a big reason why they had to put margins on their customers, because they had run out of capital. Their customers had also breached their margins because so many of them are trading on leverage. So as GameStop went down, they needed to post collateral to stay above it, but they didn't have that collateral. So if the only way you get that collateral is by selling the stock. So they didn't force people to sell the stock. If you had the money, you could just give them the money. If you didn't have the money, then you had to sell the stock.
Right.
And this is one of the topics. If you're sitting around in the Treasury Department briefing on this, this morning, you're going to be saying things. You're going to be talking about systemic risk. Is Robinhood at this point? Is it systemically important?
John? Hold that for a second.
Does it implicate some issues on that level? And I think it's a really hard question to answer. The default would be, they certainly wouldn't qualify as like a SIFI in the current definition and the way it's thought about. But, what are the ramifications if they've got themselves extended to the point where they didn't do a trading halt because they wanted to, it was because they needed to. And, what are the other counterparties going to be thinking about this? So that's one thing that they're certainly going to be talking about inside, from the policymaker perspective. It's that systemic risk. We've covered that to such a great degree at the big, U.S. banks. It's hard to argue that that the big U.S. banks aren't super strong, well capitalized, but there's always been that question about whether that the regulation of the banks has sort of chased risk into other parts of the financial industry. So that's going to be one. The other is certainly, the SEC and the regulatory questions about it. This is behavior that regulators might want to stamp out or to limit. But how do you limit talking about stocks on the internet? It's a
right.
It's a big...
I want to come back to the systemic question for a second, and then I want to get to that question of like, well, because we have seen, just like clockwork, you can expect to see Elizabeth Warren on TV railing against whoever it is, like rail against whoever, but without solutions, right? No solutions, no idea of what should be done or even what exactly the problem is. If it's systemic, that is a question. And one thing we should note is that Robinhood isn't the only platform where traders were buying and selling and options on GameStop and AMC Entertainment and the BlackBerry. I think Ameritrade, there's like there are a bunch of them, right? A lot of all these platforms. Sure. And they were not the only ones to halt buying.
Yeah, that's an important point. Merrill Lynch, which is one of the biggest, did it too.
Yeah. So, but and again, like they're going to get the most attention. They were, number one in the App Store again. Another million downloads of Robinhood. But what is this? In your judgment, do you see a systemic? Would you be the one walking up to the Treasury Secretary's office and say, hey, you know what? I really think we do have a systemic question issue here. And, because I get it. We should, you never want to be late on a systemic question. I could rather be early than late. But
right.
Where do you really see that based on in terms of, the volume and knock-on effects if one of these platforms were to fail?
It's not obvious that it would be a systemic rise to the level of a real systemic risk like a Lehman Brothers, but you can't, I can't rule that out. And it's possible that events like, something like Robinhood having a disorderly trading problem or a fault in their platform, it's the possibility that turns into a sentiment problem for the markets. This is already a sentiment problem for the markets. That could lead to a self-fulfilling kind of lattice and chain of events.
Yes.
That would be something you can't say yes or no right now, but the economic policymakers have to be, and I guarantee you that they are, confronting that question vigorously.
But that has actually already happened. So it's not that it didn't break the markets, but these stocks did affect the overall market because there's so many long short hedge funds that were short some of these stocks, and their risk managers forced them to take down risk. So they were forced to cover shorts that had nothing to do with this and sell longs that had nothing to do with this. This week, Microsoft and Apple had great earnings, but the stock was down. The reason the stock was down was because everyone was long that and had to delever. So it didn't blow up the market, but you also can't say that GameStop didn't affect the overall market. This was not just a one stock.
But again, I would just say that that's normal. That stuff happens all the time, and we get it.
Yes, it does.
We get unwinding days once a month.
It happened. Yeah, unwinding happens every 3 to 6 months, and also we have short squeezes like this every 10 to 20 years. In 1998, this happened all the time when AOL invested in Instant Chat. The first time it was 1922. Piggly Wiggly, the Wall Street started shorting Piggly Wiggly stock, and the owner borrowed $10 million, and he went up to Wall Street and tried to corner the market. And he did corner the market, but then the regulators let the shorts off the hook and gave them more time to cover their shorts, and Piggly Wiggly went bankrupt.
That would have been, but then if you bought him out of bankruptcy at that point, though, you did well, right?
It was an amazing company.
Yeah.
Yeah. And there was nothing wrong with the company. He just borrowed $10 million.
But I think that we have obviously seen short squeezes. That happens on a day-to-day basis. But an organized campaign of short hunting.
This is unique.
Have a business model. If you have an industry if you are a hedge fund or a market neutral fund and you depend on shorts to offset your longs, the reason that you're long to the extent that you are is because you have shorts to offset them. You don't short good companies, you short companies that you think are on the brink of bankruptcy or doing badly or going to zero, like the ones that we're seeing. If you have a systemic, if you have a now structural concern that those shorts leave you extremely vulnerable, you have to change your risk profile dramatically going forward. If you can't comfort yourself that this is going to stop, that the YOLO Reddit army isn't going to, they're going to call off the hunt here, you can't feel the same way that you did 2 weeks ago about your short positions going forward. It's a really,
I think that's true. And look, look, let me say this, like, I am pro short sellers, right? I mean, I do not like the attacks on the short sellers.
Me too.
I equally do not like playing the violin for short sellers either.
Right. Exactly. Yeah.
This is a phenomenon in the world that if you are a short seller, if you're an alternative asset manager, a hedge fund, you just have to factor it into your thinking again. I do not think this changes the world forever, though, right? Because in essence, this is still a Ponzi scheme, right? Like, you still need someone
you have to get out of it. Yes.
To get out.
I think that you raise a very important point. This is another shovelful of dirt on the efficient market hypothesis' grave. I mean, this is we've had years,
but only in the short term.
We have, like,
in the short term,
fundamental price discovery in the market's been very.
But in the long term,
but only in the short term.
In the long term, they always end up trading on fundamentals.
Yeah, these guys are they're all saying crazy stuff, right? That like, they could, like, they don't care about making money or they don't get out, and it's like that can't go on it's unsustainable. You still need someone at the end of the row to buy that last share, or else you're screwed. And like, that could go on for a while. It just can't go on forever.
You need somebody that wants to own GameStop at $400 and hold it for the long term.
Right.
Okay. Yeah. I mean, obviously, these are going to crash like Icarus. Of course, they're going to go back to fundamentals. You're going to reassert to some extent, but we're in a market where this goes to the broader sense of broad market sentiment, which is we live in a market environment where impossible things occur every day. Look at the yield on Italian sovereign debt.
Yep.
It's trading lower than U.S. Treasuries.
Yep.
They don't have a government.
Case for that.
And by the way, like, there's ample evidence of me out there, $29,000 of Bitcoin later. Right? I'm saying, like, this doesn't make any sense. I don't know why anybody would invest in Bitcoin. I still think it's a fairly useless asset with cost to it. So I do agree this thing can go on for a very long time. It just can't go on forever, but even less so with equities than something like Bitcoin, in my opinion.
And just from the broader market sentiment perspective, we've heard this a lot this week. This is, one of those events where it's so easy to see you flat in a year from now, us flashing back and saying, remember the end of that bull market? Boy, that GameStop, that was like the final straw, when that was the signal that the bull market had gotten so out of hand and so crazy that eventually the referees had to come in and do something. There is, that may not be true. And it may well not be true. There are plenty of aspects that drive a very positive outlook for asset prices from here. But it's one of those things that, like, as an investor, you can't help but like file it away as this has gone a little haywire.
It is not right. Okay, but here's my, like, I think I was, like, sort of just in terms of from a regulatory standpoint, public policy standpoint, presuming it's not systemic, and I think I think the clearinghouses are doing their things. I think we've seen private money come in, cover some of these losses in certain places. Like, that's, again, like, this is all normal. I don't think it's big enough to have a systemic impact. But let's set that aside for a second. If it does, then we're having a different conversation. From a public policy standpoint, my view on this is that if someone's managing your money, right? If someone's managing your, and they're mismanaging your money, they're abusing your trust, they're not acting as a fiduciary, and you throw the book at those guys, right? Like they deserve it. If you've got people marketing financial products that are shady, that are not what they appear to be, if they're hiding information in legal language and tiny footnotes in the back of a prospectus, throw the book at them. Call the SEC, call the FTC, call CFPB, get them all involved, throw the book at them. Individuals doing stupid things and right, individuals with their own money, taking on their own risk, not on behalf of other people, speaking in public, not hiding somewhere in dark rooms anywhere, right? Public platforms, Twitter and Reddit that you can get into. What exactly is the public policy interest here? I don't think we can or should try to outlaw stupid.
I think
even if you wanted to, how do you do it?
I think that's right, but it is definitely something that is this eye-popping, and from the regulatory perspective, they all may sit down at the SEC and the Treasury and the White House and say, there's nothing illegal here. There's nothing that we can really regulate. We can't stop people from talking about stocks on the internet. But when you look up at Congress, AOC and Ted Cruz are on the same side of this issue. They came out and lambasted the decision of Robinhood, and lawmakers are clearly, and you mentioned Elizabeth Warren. Of course, if you have an interest in regulating Wall Street, or going in and just basically blowing the whistle and saying, look, this is time to step back and take a long, hard look at our financial system writ large and see where things are. This is a perfect trigger. And this is the perfect opportunity for you to do that. And the political climate up on Capitol Hill clearly shows that there's potential for, maybe they would never agree on the actual policy approach, but there's at least convergence in the outrage factor on both sides of the aisle. And so this is something that I think is one to watch. We're not advocating one way or the other, but if you had a mind to regulating Wall Street and you were in the policy sphere, this would be a good time to try to push that.
I think you're right. But at the same time, say the guys on Wall Street that you don't like, they're the ones who paid the price on this. What exactly is it that you think needs to be fixed here? What's the thing?
Well, I think Ted Cruz and AOC both said what needs to be fixed is real retail investors getting the shaft. And that is something.
But who gave them the shaft?
So two things need to be investigated.
Who shafted them?
I mean,
but two serious things do need to be. Two things need to be investigated. One, did any hedge fund put undue pressure on Robinhood to halt trading yesterday? I don't think that's the case, but that needs to be investigated. Two, were there any hedge funds with prior positions in GameStop in these Reddit rooms pretending to be retail investors that got this thing going? Those are two things that the SEC should investigate.
Yeah, by the way,
everything else that's happened is perfectly legal.
Yeah, but John, if that's the case, if a hedge fund did that, right?
I don't think it did, but that's something that they should actually look into.
There is a law on that. That's it. That is fraudulent.
And I'm sure the SEC is already actively doing that. Yeah.
Yeah.
You don't need a congressional hearing to do it. It's happening as we speak. And honestly, it's a very easy one to trace.
I'm afraid we're going to.
I don't think any hedge fund would be dumb enough to do it, but.
Go ahead, John.
Just the last point.
Because they get caught.
This is a point that is the more in the weeds, but basically, if you accept the premise that this is to some degree, a symptom of a very easy liquidity environment, an easy monetary environment, and you say, well, the Fed has zero interest rates, which has driven people into the stock market because they can't get good yields on bonds and so on and so forth, blah, blah, blah. Basically, the question is, the Fed is clearly targeting and orienting and calibrating their policies to assist a recovery in the most damaged part of the U.S. economy, which is brutally beset by COVID and desperately needs help. How do you calibrate policy to allow that part of the economy to heal without risking overheating in the healthy and even benefiting parts of the economy and blowing a potential asset bubble while you're doing that? And that's a real conundrum. And targeting fiscal stimulus is something that the Biden administration, President Biden has said, he's open to that. That's easier to do. How do you target monetary policy?
I think that's exactly right. And then why don't we take a break here and come back, because we did have FOMC meeting this week also, and Chairman Powell was asked some of these questions, and let's go into it a little bit more deeply about some of the broader broader issues that might be fueling some of this, and if that's the case. You're listening to the Macrocast.
The Sadie Collective's 2021 annual conference will take place on February 19th and 20th, celebrating Dr. Alexander's 100th anniversary of becoming the first African American to earn a PhD in economics. The 2-day virtual event will feature leading Black women across economics, business, tech, healthcare, and policy. Email Sadie Collective at hamiltonps.com or visit sadiecollective.org/SACE 2021 for more information.
We're back on the Macrocast. John, you started talking about this in the first segment, and we definitely want to get into it a little bit more. Like there is this story out there that, and even the Robinhood CEO on an interview with Andrew Ross Sorkin last night on CNBC brought this up too, that you have this combination of a lot of money out there. Seems crazy to talk about during in the middle of some of the economic situations big segments of the economy and population are facing, but a lot of money sloshing out there, a lot of easy money, and a lot of idle young men working from home who can get on and look at stocks and get up to mischief on Reddit and subreddit.
And you can trade for free now.
You can trade for free. There's no fee trading.
And you can borrow. You can lever yourself.
You can lever. You can get into more sophisticated instruments like futures trading and lots of other things. So, but I'm sympathetic to this story, as you started to say, John. And we've talked about this before. The instruments of the Fed are mostly blunt, right? Like they're, in fact, by nature, they have to address the entire economy. That means that in order to get to certain pockets of the economy that may not be doing very well, they have to elevate the economy for everyone, and that just means that you overheat certain places too. Even on fiscal policy, we've seen money going out. Whether it's the checks from last March and April, or the most recent checks that people are getting. We know a lot of those checks are going to people who don't actually need. They're not in financial distress, but they're getting the checks also as sort of a stimulus boost. And I would have liked to seen it more targeted, but nonetheless, that's where it is. So there's this money sloshing around. A lot of people still with jobs and not a lot of places to spend it. You can't spend it on going to Aruba, so you spend it on buying stocks, which you can do from your home computer. So I think that's an interesting story. At the same time, is it really that big? Do you think it's enough? Is it enough? I mean, I'm not, I don't want to, I was trying to think, I was trying to do the math on it, just how much money is out there. And is it really that much? I mean, these guys got money back in, I guess if you're borrowing, you can do it, but we've seen elevated borrowing. Is that something that we're noticing from these guys, or is it just so distributed among, millions of traders that a little bit looks like a lot? A little bit is a lot, actually.
Yeah, I mean, I think that the story of the retail investor is that story. It's maybe the kind of narrative is they get their stimulus check and then lever it up on Robinhood and go bananas buying GameStop. But the reality is a lot of people have, and we talked about this with John Dick last week. There are a lot of people with pent up savings. They haven't been able to spend on the things that they wanted to spend on, and what are they doing with the extra money? And certainly this has been one outlet for that. And whether our retail balances and leverage, are those high? Yeah, they're pretty high.
Yeah.
But this is it's not the same kind of it's not the same kind of concentrated risk that you get with the pre-2008, a bunch of systemically important institutions putting their institutional integrity on the line and making these bets. It's much more diffuse. And so when you're thinking about market risk from the Fed perspective, clearly they've got a bank centric, a bank mega bank centric or regional bank centric view of market of systemic risks, and I think rightly so. And they can feel pretty confident that those are in really good shape. So that gives them a baseline where they can look at some of the other things that are going on in the market and worry less about it. And Chair Powell basically came in and he really didn't take the bait. Talking about GameStop, he wouldn't go there really. And when it came to the question about whether low interest rates and the monetary policy settings are the gasoline that have been sparked and lit up by this, he said he tried to downplay that as well, saying that low interest rates have a lot less to do with asset price upside than you might think. And that's a story that I don't know if he would get necessarily a lot of agreement on in the financial industry. There's some aspect when it comes to like quantitative easing, they're buying $120 billion a month in treasuries and mortgage-backed securities. And why is that? Why does that lift stocks? For the average person, the connection isn't necessarily all that clear. And, the idea of, well, it suppresses long-term interest rates. And so that allows you to have a more favorable discounting mechanism for your stock valuation models, particularly the tech companies that have much really long dated kinds of earnings profiles. That's easy to explain. The idea that the Fed is taking 10-year treasury equivalents out of the market and chasing investors into other assets. They're chasing them to, first, if you take 10-year yields out of then you got to go to corporate bonds to get that yield. And then if you were in corporate bonds, you might have to take junk to get that yield. My parents are, in their 80s, and they're supposed to be 80% in bonds and 20% in stocks. Yeah, right. They're 80% in stocks not because they want to be, because they can't, get the income. So that's one of the, but it's still very hard to model exactly what quantitative easing does. And there's an element of like magic and belief. The idea that when the Fed does QE, stocks go up, and it's really never, it's never failed. And so Wall Street believes that it's kind of this magical elixir that levitates all asset prices costlessly.
Yeah. Well, there's not, look, we're not, if that's what they believe, and it seems to be true, and we know that, the market really does function in a lot of ways based on what people believe, right? It is a confidence game, and I don't say that as a pejorative, right? It's just like you need to have some faith in the future. Their faith in the future right now is that none of that is changing at the Fed, right? Fed is steady.
Why is the Fed? You're focused expressly on the lower income echelons that have been decimated by this pandemic, and they need so much healing. It's really, you have to basically, as the Fed, I think you have to kick it back to lawmakers and regulators and say, look, you have to keep financial markets on side. If you think that those are, you got to have a regulatory solution or a legislative solution, the Fed doesn't really they don't have much of a choice. One of the things they can do, and if markets continue like this, these kind of elements, Chair Powell might find himself, or some of his colleagues might find themselves talking more about, we're watching excesses in the markets. Boy, if they start going there, the markets are going to have a really different feel.
That is clearly definitely a way. That is definitely language that would engineer, some kind of pullback for sure. At the same time, though, I often I'm always thinking about the interplay between monetary policy and fiscal policy, and that like I said, by definition, the vast majority of what the Fed does is always going to be about like broader a function of broader markets, credit markets, and the policy rate, and some things they can do by regulation and their oversight and supervisory role of big parts of the financial system. But it does seem to me, though, that what we'd really want to see is more predictable and targeted help on the fiscal side, so that the monetary authority doesn't have to do so much, and you don't have to do so much of like sort of fiat administrative engineering of finance, because you always end up with other unintended consequences and not a smoothly functioning market.
Yeah, the most targeted programs the Fed had were those SPVs that were canceled by the outgoing administration's Treasury Department, the Main Street Lending Program and the state and local municipality liquidity facility. Those are targeted, but I don't want to veer this down a path that's
well worn,
too MMT like, but. If you were an MMT maven, you'd be saying, of course, it's not the Fed's job to hit the brakes. In this formulation, MMT, that's tax policy. You should be trying to keep, if you've got the financial industry going crazy, but monetary policy is appropriate for the part of the economy you're targeting. You should have a financial transaction tax, or you should raise, if you're worried about the top part of the economy overheating, you should raise the taxes on them. That's the MMT approach, I think.
Well, yeah, definitely. I understand the tax function on MMT, and I'm not an MMT adherent. I just think that, and Jason Furman had wrote about this, and I know, like, I always feel good when, like, I know I've said things, and I was arguing this back in the Treasury building, when I worked there 16, 17 years ago, and that, about automatic, triggers and automatic stabilizers. We were in these like ridiculous fights over extending unemployment benefits, and and you look how sort of food stamps and other automatic stabilizers work really, really well, and they're basic triggers, and no one has to wait, and they're highly targeted. You'd like to see a lot more of that, for example, John, than even like some of what we've heard from MMT, but even the kinds of exotic things that the Fed has had to do. To me, like, those are fiscal functions. They should be targeted, and you go and you give the money to the people who most need it the moment they need it, not making them wait and jump through hoops and do crazy things. And if you could put that on a predictable path, so that everybody knows what's coming, what your borrowing needs are going to be, I think you actually end up with smoother downturns.
Yeah.
Yeah.
You save money by doing that.
Costs over time. I mean, this is like a no-brainer to me. And I hope that we move to that. I mean, if this administration can, wants to come to some, revolution on this, I think that more triggers, more automatic stabilizers, I think would go a long way towards this, smooth economic functioning of this economy over time.
I think the best thing they can do is to advise every American to bet the Bruins over the Penguins because it's free money.
Don't get me started.
Insert disclaimer here.
Don't get me started. Don't get me started. All right. Hey, let's come back. We'll take a look ahead. We'll take a break now and come back on the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, guys, we're back on the Macrocast. Want to look ahead to next week, and I can't even believe that it's we're gonna have Jobs Day again next week. We're gonna have payrolls. What should we be paying attention to?
Well, yeah, January is definitely an interesting month. So there's a lot wrapped into this jobs number, I suppose, between everything that was happening at the Capitol. We actually did transition to a new president, and we kind of went on lockdown on our own because of spiking COVID cases. So I think we'll be looking to see how the economy is holding up under that scenario, and then whether that can put more pressure on Congress on further stimulus.
Yeah, the big negotiations are going to happen next week, and it seems like we've got the dual track where the Biden administration is going to come in with the full $1.9 trillion on one side and a more bipartisan focused, slimmed down 600 to 800 billion approach and see which one wins out. So that'll be a key focus next week for sure.
Yeah, either way, more is coming, right?
It is kind of amazing where we'd be disappointed with 800 billion, but that was just a little less than what the Obama administration did in total to get us out of the 08 crisis. So it's amazing how 13 years have changed. Yeah,
if you go back, you go back to the fall when there was debate, like the Democrats had this $3.4 billion or $1 trillion plan out there. Republicans were saying 500 billion. And we're all saying it's going to be somewhere in the middle, We're kind of somewhere in the middle, right?
Yeah.
I mean, at the end of the day, you could take the 900 billion from December. Maybe it's another 900 or trillion. This time, I don't know if maybe it does get to 1.9, but we'll see if its reconciliation is going to be something less. But it's kind of in the middle. It just took way longer than was necessary. If they just settled on the middle,
exactly,
3 months ago, the world would be a better place. Well, we'll see if anything shows up in jobs. I think if that's a disappointing number, I think it is going to spur some more attention on getting something done. And but we'll have that to talk about. And I'm sorry to say, I'm really disappointed to say that we'll probably have something to say about GameStop again next week.
Exactly.
So, guys, have a great weekend. We'll see you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.